Imagine it's November 15th, 1923. You are a 52-year-old schoolteacher living in Dresden, Germany. You have taught mathematics for 29 years and you have done everything right. You own a modest apartment near the Elbe River. You save diligently every month of your working life, and you hold government bonds that were once worth enough to retire on comfortably. Your routine is the same every morning: coffee, newspaper, a walk to the schoolhouse, and the quiet confidence of a man who followed all the rules. Your savings. Book shows a number that once represented 3 decades of discipline and sacrifice. You believe, like everyone around you believes, that money in the bank is the safest thing a careful person can own. If you have ever wondered why some families get wiped out in a crisis while others walk through the fire untouched, stay with me. What you are about to hear is not a theory, it is a pattern. It has happened before, in different countries, in different centuries, and it always ends the same way. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Now here's the dramatic turn. On that November morning in 1923, a single loaf of bread in Germany costs around 200 billion marks. Your entire life savings, all 29 years of it, is no longer enough to buy breakfast. The bonds are worthless paper. The savings book is a museum piece. But here is the part of the story that almost nobody tells. 20 kilometers outside Dresden, a farmer you once considered beneath you, a man with dirt under his fingernails who never owned a bond in his life, is doing fine. Better than fine. City families are arriving at his gate every day, trading pianos, jewelry, fur coats, and gold watches for sacks of potatoes and sides of bacon. His wealth did not sit in a bank. It grew out of the ground. And when the money died, his land kept producing the one thing no one can live without. This video is about that land. Specifically, it is about farmland, the asset that almost nobody talks about, that never trends on social media, that your financial news feed ignores completely, and that, according to decades of data we will walk through together, has quietly matched or beaten the stock market over roughly the last 50 years, while doing something stocks have never done. It kept people alive when entire monetary systems collapsed. This is not a video telling you to buy anything. It is a historical autopsy. We are going to open up 3 different collapses in 3 different countries, in 3 different eras, and look at what happened to the people who owned productive land versus the people who owned paper. The pattern you're about to see is one you will never be able to unsee. Before we go further, there is something important to understand. Why would farmland, of all things, hold up when everything else fails? The answer comes down to one simple idea. There are 2 kinds of wealth in this world. There is paper wealth, which is a claim on something, a promise, a story that everyone agrees to believe. Stocks, bonds, currencies, bank deposits, all of them are promises. And then there is productive wealth, which is something that creates value by itself, whether or not anyone believes in it. A stock certificate is a story printed on paper. A field of wheat is a machine that turns sunlight, rain, and soil into food every single year, forever. The story can die overnight. The machine keeps running. Here is the metaphor that unlocks everything. Paper wealth is a boat tied to a dock with rope made of trust. As long as everyone trusts the rope, the boat floats exactly where you left it. But when trust snaps, and history shows it can snap in weeks, the boat drifts away and you cannot get it back. Farmland is not a boat. Farmland is the shore. It does not float on trust. It just exists. And it produces. And every human being on Earth needs what it produces 3 times a day. Economists call this an inelastic demand, which simply means demand that does not go away no matter what happens. Because people must eat, whether the economy is booming or burning. That is the secret key. Hold on to it, because we are about to use it to unlock 3 of the darkest financial chapters of the last 100 years. This brings us directly to the first major point. Farmland survives the death of money itself. To see this clearly, we go back to Germany between 1921 and 1923, the most famous monetary collapse in modern history. After losing the First World War, Germany owed enormous reparations, which means forced payments to the winning countries, and its government made a fateful choice. Instead of raising the money honestly, it simply printed it. In January of 1922, $1 bought around 190 German marks. By November of 1923, $1 bought roughly 4.2 trillion marks. That number is so large it stops meaning anything, so let me make it human. Workers were paid twice a day and given breaks to run and spend their wages before prices rose again by evening. People burned banknotes for heat because the paper was worth less than firewood. A widow who had sold her house in 1921 and put the money in the bank found, 2 years later, that the entire sale price of her home would not buy a postage stamp. The middle class of Germany, the teachers, clerks, engineers, and pensioners who had saved in marks and bonds, was financially annihilated. Historians widely point to this destruction of the careful, rule-following middle class as one of the poisons that later helped destabilize the entire country. But now look at what happened in the countryside. German farmers came through hyperinflation in a completely different condition. Their wealth was in soil, livestock, and grain, none of which cared what a mark was worth. Even better, many farmers had mortgages, which means loans against their land, and those loans were written in marks. As the mark died, their debts effectively evaporated. A farmer who owed the equivalent of a house in 1921 could pay off the entire loan with the price of an egg in 1923. City dwellers streamed into rural areas in what people at the time described as a great bartering migration, trading heirlooms, silverware, and Persian rugs for butter and ham. There are recorded accounts of farmhouses in this period filling up with pianos, because a piano, a symbol of urban middle-class refinement, had become worth roughly one winter of food. Notice the mechanism, because it is the engine of this entire video. The farmer did not outsmart anyone. He did not predict the collapse. He did not trade currencies or read economic forecasts. He simply owned an asset that produced something real. When the unit of measurement died, the thing being measured kept its value. Land measured in marks went to absurd numbers, but land measured in loaves of bread, in eggs, in human survival, held steady. The rot was in the paper, not in the soil. And when Germany finally stabilized its currency in late 1923 with the Rentenmark, a new currency, the government backed it partly with a claim on German agricultural and industrial land, because land was the only thing left that everyone still believed in. Think about that. When the entire financial system needed to rebuild trust from zero, it reached for farmland. That fact alone tells you where value hides when everything else fails. Here is something I want you to think about before we go further. If your country's currency lost 90% of its value over the next 2 years, what do you actually own right now that would still matter? Not what your accounts say, what you truly own. Drop your answer in the comments. Seriously, I read them, and the answers to this question are always revealing. Because what I am about to show you next is the part of this story that most people never hear. It is not about collapse at all. It is about what farmland does in normal times, in a stable country over 50 boring years, and it changes everything. This leads to the second part of this story and the second major point. Farmland does not just survive disasters. In quiet times, it compounds. Compounding means your gains earn their own gains, like a snowball rolling downhill picking up more snow with every turn. And the numbers here, from the United States of all places, are the numbers almost nobody knows. According to the United States Department of Agriculture, which has tracked land values for over a century, the average acre of American farmland was worth roughly $196 in 1970. By 2024, that same average acre was worth over $4,000, with quality cropland in the Corn Belt going far higher. That is roughly a 20-fold increase in the price of the land alone. But here is what most people miss. That price growth is only half the return. Farmland also pays you every year through crops or through rent paid by the farmer who works it, and historically that rental income has added several percent annually on top of the price appreciation. When you combine both parts, the picture becomes remarkable. The NCREIF Farmland Index, which is the main professional benchmark tracking institutional farmland investments in the United States, has recorded average total returns in the neighborhood of 10 to 11% per year since it began in 1991. That is in the same league as the stock market's long-term average, and various studies looking back over the last 50 years suggest farmland has matched or beaten stocks over long stretches, with one enormous difference: volatility. Volatility means how violently the price swings up and down. Stocks have crashed by half multiple times in the last 50 years, in 1973, in 2000, and 2008. Farmland's yearly returns, by contrast, have moved with the calm of a slow river. It rarely makes headlines because it rarely does anything dramatic. And that is exactly why almost everyone ignores it. We are wired to notice fireworks, not sunrises. But the sunrise happens every single day. Look at what one famous investor did with this knowledge. In 1986, Warren Buffett bought a 400-acre farm in Nebraska for $280,000. He knew nothing about operating a farm, and he said so openly. But he estimated the farm's yearly production, its corn and soybeans, and calculated that the land would return a solid yield that would grow over time as crops improved and prices rose. He later wrote that decades on, the farm had tripled its earnings and was worth 5 times or more what he paid, and that he never once needed a daily price quote to feel secure about it. His point was simple and devastating. He owned a productive asset, judged by what it produced, not by what a screaming market said about it minute to minute. The wheat does not check the news. It just grows. Now here's where it gets interesting, because you might be thinking this is an American story, a lucky country with stable institutions. So let us take this pattern somewhere much darker and see if it holds. This brings us to the third major point. Farmland protects people even in modern 21st century collapses, not just in black and white photographs from 1923. Consider Argentina in December of 2001. Argentina was not a poor country. A century earlier, it had been one of the richest nations on earth. Its middle class had bank accounts, credit cards, apartments in Buenos Aires, and savings held in US dollars inside Argentine. Banks, which everyone believed were safe. Then, in the first days of December 2001, the government froze bank accounts in an event Argentines still call the Corralito, which roughly means the little corral, because people's money was penned in like animals. Withdrawals were limited to a few hundred pesos a week. Weeks later, the government abandoned the one-to-one peg between the peso and the peso lost roughly 70% of its value in months. Dollar savings were forcibly converted into devalued pesos. Overnight, middle-class families who had done everything right lost the majority of their life savings, while the money sat locked behind bank glass they could see but not touch. Riots swept the country. The president fled the presidential palace by helicopter. Argentina cycled through 5 presidents in 2 weeks and defaulted on roughly $93 billion of debt, at the time the largest sovereign default in history. Now shift your eyes from the capital city to the Pampas, the vast fertile plains that make Argentina one of the great breadbaskets of the world. Argentine farmers sold soybeans, wheat, and beef to foreign buyers, and foreign buyers paid in dollars. When the peso collapsed, the farmers' costs, in pesos, fell through this floor, while their revenues in dollars held firm. The devaluation that destroyed the urban saver handed the exporting farmer a windfall. In the years right after the collapse, Argentine agriculture boomed, soy production expanded dramatically, and farmland in Argentina, priced in real terms, held its value and then climbed while bank deposits had been gutted. The same event, the same country, the same months, produced 2 opposite outcomes, and the dividing line was simply what kind of asset you held when the music stopped. Paper claims inside a failing system, or productive land whose customers lived outside that system. The mechanism here is the purest version yet of what we have been describing. When a home becomes a global store of wealth, its usefulness as shelter becomes irrelevant to the owner. An empty apartment in a Vancouver tower and a bar of gold in a vault serve the same purpose in the owner's mind. Both are just wealth, sitting still, waiting to be worth more. The difference is that no family ever needed to sleep inside a bar of gold. But that empty apartment could have been someone's home. It could have been the home of a nurse working at the hospital 10 minutes away, who, instead, has to commute 2 hours, because there is nothing near her work that she can afford. And here is the counterintuitive fact that most people miss. Building more of this kind of housing does not fix the problem. Vancouver built and built, towers went up everywhere. But if the new homes are simply absorbed into the global wealth bucket, if they are bought as investments and left empty, then building more does not house more people. It just creates more wealth containers. It is like trying to end a drought by building more swimming pools for the rich, then wondering why the taps in ordinary homes still run dry. Now observe what all 3 of these cases have in common, because this is where you will not be able to unsee it. Most people will never make the connection you are about to make. Most people will keep believing that a housing crisis simply means we did not build enough houses and that empty investment properties are just an odd side story. If you are still here, following this all the way, you are already thinking differently from the crowd. Hit subscribe, because this next part, the part where the whole pattern snaps into focus, is exactly the part this channel was made for. The part they never quite put in the textbooks. Now look at all 3 together. Ireland in the years after 2008, Japan in the decades after 1991, Vancouver through the 2000s and 2010s, 3 different continents, 3 different cultures, 3 different decades. On the surface, they look like completely separate stories. A crash here, an aging population there, foreign money somewhere else. But underneath, it is the same machine running the same program. In every single case, homes were pulled out of the use bucket, the bucket of shelter and human need, and dropped into the wealth bucket, the bucket of investment and speculation. In every case, that shift made emptiness profitable, or at least acceptable to the people who owned the property. And in every case, the result was the same haunting contradiction. Empty homes and desperate people standing side by side in the same city at the same time. The same mechanism, different countries, different decades, same result. Homes built for spreadsheets instead of people, homes valued for the number they might reach instead of the lives they might hold. And once you see that the emptiness is not a glitch, not a mistake, not an accident, but the logical outcome of treating shelter as an investment vehicle, you cannot unsee it. You will look at every dark tower, every fenced-off ghost estate, every crumbling akia, and you will understand exactly what you are looking at. Collapse in affordable housing is not a fire that burns everything down in one night. It is a river slowly changing course, carving a new path over years, until one day people look up and realize the water no longer flows where the town was built. The homes are still there. The buildings are still standing. But the purpose has drifted away, downstream into the ocean of global money. And this is where history gets uncomfortable, because a pattern this consistent across this many places is not bad luck. It is design, not a conspiracy in a dark room, but the natural result of rules and incentives that quietly reward the wrong thing. When the biggest profits come from holding property empty and waiting, then property will be held empty. Water flows downhill. Money flows toward profit. And if the profit lies in emptiness, then emptiness is what you will get, no matter how loudly everyone claims to care about housing the poor. Which brings us to the hardest question of all. If this is the pattern, then who actually pays the price? And who walks away untouched? Let us be very specific, because this is where the human cost becomes real. This is not about numbers on a chart. It is about lives. The people who get hurt the most are almost always the same. Young workers just starting out who have no property yet and watch the ladder pulled up out of reach before they can climb it. Renters who face rising costs every year with nothing to show for it. No ownership, no security, just payments vanishing into someone else's investment. The elderly on fixed incomes who cannot absorb rising housing costs. And low-income families, teachers, cleaners, care workers, the people who physically keep a city alive, who increasingly cannot afford to live in the very cities they serve. In Ireland, after the crash, an entire generation was scarred. Many young people emigrated, leaving the country entirely because there was no affordable future for them at home. Estimates suggest tens of thousands left Ireland each year in the worst years after 2008, a painful echo of much older waves of Irish emigration. Families were trapped in negative equity for a decade, unable to move, unable to sell, chained to a debt larger than the home was worth. And in the ghost estates, the few families who did move in sometimes lived surrounded by empty, unfinished houses with unpaved roads, broken street lighting, and no neighbors, raising their children in half-built ghost towns. In Japan, the young increasingly gave up on the idea of the large family home their parents had known, squeezing into tiny urban apartments while the countryside emptied out and decayed. In Vancouver, working families were pushed farther and farther from the center, spending hours commuting, their lives eaten up by travel, because the homes near their jobs had become deposit boxes for wealth they would never touch. Now, who walked away fine? Who won? The pattern there is just as clear. The people who already owned property before the wave came in did well, watching the value of what they held climb higher and higher. The investors who treated homes as assets and who had the money to buy and hold and wait did well. The wealthy, both local and global, who had somewhere to store their money and the patience to let it grow did very well indeed. The gap between those who owned and those who did not grew into a canyon. And here is the quiet cruelty of it. The system did not feel evil to the people benefiting from it. To them, it just felt like being smart, like making a good investment. Each individual buying an empty apartment as a safe place for their savings was simply doing what seemed sensible for their own family. But add up millions of those sensible individual choices, and together they form a machine that quietly locks an entire generation out of the most basic human need. Nobody has to intend harm for enormous harm to happen. The floor gives way beneath the young and the poor, but the cracks had been spreading invisibly for years, hidden inside the ordinary logic of investment. So the question naturally becomes, when this pattern takes hold, is there anything that separates the people who came through it from the people who were crushed by it? History does offer some clues. The question is not whether this pattern will appear again. History has already answered that. It has appeared in Ireland, in Japan, in Spain, where after the 2008 crash, there were estimated to be over 3 million empty homes. In China, where entire so-called ghost cities were built and stood largely empty for years. The only real question is whether you can learn to see the pattern clearly before it shapes your life without your knowledge. If this channel helps you think differently about the world you actually live in, subscribe. It costs nothing. And understanding how these forces move is something no one can ever take away from you. So what did the people who came through these periods have in common? I want to be very careful here. This is not financial advice, and I am not telling you what to do with your money. I'm simply describing what the historical record shows. And the record suggests that those who navigated these housing storms with the least damage tended to share a few characteristics. The first was understanding, clear-eyed and early. They understood the difference between a home as shelter and a home as a speculative bet, and they did not confuse the two. When everyone around them was chanting that prices only go up, they remembered that this exact belief had preceded every major housing collapse in history. They did not get swept up in the certainty of the crowd, because they knew that total certainty is often the loudest warning sign of all. In Ireland, the ones who resisted the pressure to buy at any price during the mania, who refused to stretch themselves to dangerous extremes, were often far better protected when the collapse came. The second characteristic was caution about debt. The people who were destroyed in these crises were very often the people who had borrowed the most, stretching themselves to the absolute limit on the assumption that rising prices would bail them out. When prices fell, that debt became a trap with no exit. Those who came through with more of their lives intact tended to be those who had not tied their entire future to a single enormous, fragile bet, and who kept some room to breathe when conditions turned against them. The third characteristic was a refusal to believe that this time is different. In every bubble, in every country, people convinced themselves that the old rules no longer applied, that their city was special, that the IR moment was unique, that the endless rise was permanent. The historical record is brutally consistent on this point. The words "this time, it is different" have preceded more financial pain than almost any other phrase in human history. Those who stayed humble, who studied the past, who assumed that what had happened before could happen again, were the ones least likely to be caught completely unprepared. Notice that none of these are secret tricks or clever schemes. They are simply the habits of people who saw the machine for what it was and refused to mistake a wealth bucket for a home. Now let us return, one last time, to that young teacher in Dublin, standing in her rented flat on a June morning in 2007, dreaming of one of those bright new houses on the edge of the city. We do not know exactly which path she took, but we know the paths that were available. If she stretched herself and bought at the peak, she likely spent the following decade trapped under a mountain of debt, watching the value of her home collapse, chained to a number that no longer made sense. If she held back, she watched rents rise year after year, and she watched the ghost estates decay in the EU. Distance, empty houses in a country full of people who needed homes. Either way, she carried with her a hard truth that an entire generation across the world has now learned. That a country can be full of houses and empty of homes at the very same time. And that is the final lesson. The housing crisis in so many places is not, at its root, only a story about not building enough. It is a story about what we allow homes to become. When shelter is treated first as a way to store and grow wealth, and only second as a place for human beings to live, then emptiness becomes profitable, scarcity becomes valuable, and the people who simply need somewhere to sleep are pushed to the very back of the line. The buildings rise, the lights stay dark, and the contradiction deepens. This has happened before, in country after country, and the mechanism has been the same every single time. History does not tell us exactly when it will appear next, but it shows us, with painful clarity, exactly how it works and exactly what it costs. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will scroll right past it and keep believing that empty towers and unaffordable homes are just two unrelated pieces of bad luck. But if one person in your life keeps asking how there can be so many empty houses while they cannot afford a place to live, share this with them, not because it will change the whole world, because it might change the way they see theirs. Subscribe for more, and I will see you in the next one.